Have you ever wondered why some businesses grow fast while others struggle, even when they earn the same revenue? The secret often lies in one simple thing: a well-planned business budget. Without a clear budget, even profitable companies can run out of cash, overspend, or miss growth opportunities. In this video, you will learn 5 practical steps to developing a business budget. Step number 1: assess your business goals and financial position. Every business budget begins with a clear understanding of goals and the current financial position. Start by asking yourself, what do you want this budget to accomplish? Are you aiming for business expansion, operational stability, or debt reduction? Having clarity helps set priorities and allocate funds wisely. Review your previous financial statements, income statement, balance sheet, and cash flow to understand where your business stands. Identify patterns in revenue and expenses over the last 12 months. Look for profit margins, high-cost departments, and areas where spending can be reduced without hurting productivity. If you're a new entrepreneur, use market research, industry averages, and competitor benchmarks to estimate figures realistically. Avoid guessing. Every number in your budget should come from either data or well-researched projections. Create a clear picture of your fixed costs like rent, insurance, salaries, and variable costs like marketing, supplies, utilities. This baseline allows you to project future needs more accurately. A strong assessment step ensures your budget isn't just a random spreadsheet. It becomes a financial roadmap guiding smarter daily decisions and long-term growth. The better you understand your financial standing now, the more confident you'll be in managing every rupee, dollar, or euro tomorrow. Step number 2: estimate and diversify revenue streams. Once you know your financial baseline, the next step is forecasting income. Revenue estimation is not about being overly optimistic, it's about being practical. Start by identifying all existing income sources, such as product sales, subscriptions, consulting fees, or franchise earnings. Then look for additional opportunities that could grow over the coming months. These might include partnerships, digital products, training programs, or affiliate income. For established businesses, analyze the last 2 to 3 years of revenue trends to recognize seasonality. For example, a tourism company might peak during holidays, while B2B businesses might see quarterly surges. Always use conservative figures when estimating. Budgeting based on best-case scenarios can lead to shortfalls later. Include both recurring and one-time revenues in separate categories to avoid confusion. Also, plan how you'll collect money. Delayed payments can disrupt cash flow even when sales look strong on paper. Build a habit of reviewing customer payment cycles, invoice terms, and credit policies. A diversified revenue approach keeps your business safer during downturns. Never depend on just one income source. Multiple revenue streams act like safety nets. The goal here is simple. Create a reliable, predictable flow of income that covers operational needs and supports growth, no matter what market fluctuations occur. Step number 3: list, categorize, and control business expenses. Now it's time to understand exactly where your money goes. Start by listing every expense your business incurs, no matter how small. Divide them into 3 categories: fixed, variable, and discretionary. Fixed expenses are predictable costs, such as rent, insurance, software subscriptions, employee salaries, and loan repayments. Variable expenses change according to production, marketing campaigns, or seasonal sales, like raw materials, delivery costs, or commissions. Discretionary expenses include non-essential spending such as team outings or luxury upgrades. Once listed, analyze which costs directly contribute to revenue and which don't. Cut or reduce unnecessary spending, but never compromise on quality or customer satisfaction. A smart practice is applying the 80-20 rule. Focus on the 20% of costs that drive 80% of results. Additionally, set aside 5 to 10% of your total budget for unexpected expenses. These could be emergency repairs, legal issues, or sudden market changes. Use digital accounting tools such as QuickBooks, Xero, or Zoho Books to automate tracking and gain real-time visibility. Reviewing your expenses weekly or monthly helps identify overspending early. The purpose of this step isn't just cost-cutting, it's cost control. When you actively manage expenses, you maintain cash flow stability, improve profit margins, and build a stronger, more resilient business model that survives uncertain times. Step number 4, create and maintain a cash flow forecast. A realistic cash flow forecast is the backbone of a solid business budget. Many businesses fail not because of low profits, but because of poor cash management. Start by projecting all incoming and outgoing cash for the next 12 months. List expected inflows, sales, loans, investor funds, and outflows, such as salaries, rent, vendor payments, and taxes. This helps you predict when you might face a cash shortage or surplus. Make sure to include payment timing. For instance, if clients take 30 days to pay invoices, your revenue timing shifts. Use spreadsheet templates or tools like Microsoft Excel, Google Sheets, or Float for automation. Always keep at least 3 months of operational expenses as a safety buffer. Review your forecast every month and adjust based on real data. If sales dip or costs rise, modify your spending plan immediately rather than waiting for year-end reviews. Cash flow forecasting also allows you to plan investments, knowing exactly when to reinvest or when to pause expansion. For startups, tracking burn rate, how quickly you spend capital, helps calculate how many months of survival you have. Ultimately, a well-maintained forecast keeps your business liquid, reduces stress, and ensures you can meet financial obligations smoothly, even during challenging periods. Step number 5, review, adjust, and communicate your budget. A budget only works when it's reviewed regularly and updated as your business evolves. Treat your budget like a living document, not a one-time task. Schedule monthly or quarterly reviews to compare actual performance against your projections. Conduct a variance analysis to identify differences between estimated and real numbers. If marketing spends are higher but bringing strong returns, continue. If a department overspends with no result, take corrective action. Encourage feedback from team members involved in finances, operations, and sales. They often spot inefficiencies early. Make use of visualization dashboards in tools like FreshBooks or Zoho Analytics to simplify tracking. Adjust figures based on market trends, new opportunities, or inflation changes. Also, ensure transparency. When your employees understand budget goals, they align their decisions with company objectives. Set measurable financial KPIs such as gross profit margin, ROI, and customer acquisition cost. Share progress updates across teams to maintain accountability. Finally, store your budgets securely in cloud-based systems for quick access and collaboration. Reviewing and communicating your budget consistently keeps your business agile, resilient, and financially smart. Remember, the best budgets are not perfect. They're flexible, realistic, and constantly evolving along with your business growth and market conditions. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.